Yo, what's going on, everybody? It is Wednesday, September 20th. So, today just played out exactly as I thought it was going to play out. The market tried to rally. Well, it was a kind of a mixed bag. I mean, the Dow was up almost 200 points early before the Fed meeting. I've been saying in these videos that the monetarist zombies are just gonna dump all over the market, because no matter what Powell says, if it's not explicitly saying that the Fed is done and they're going to start cutting rates, which I said that is not going to happen, then the zombies are going to sell. And that's exactly what happened today. And you have to understand that the Fed, Powell, is doing the quote unquote work of the White House. And what I mean by that is that the Biden administration, the Biden team, believes that inflation is a major impediment to the re-election of Joe Biden next year. And they may be right, but the problem is that the White House has ceded the responsibility of tackling inflation over to the Fed. And the other problem is that the Fed's remedy, quote unquote, is the wrong remedy. I mean, I've said this a million times, that raising interest rates is not going to squash inflation. The cost of credit is reflected in the cost of all goods and services, and when you raise interest rates, it just raises the general price level. I mean, inflation would be a lot lower right now if the Fed had kept the rate at zero. And again, I give you as evidence Japan and the Bank of Japan's policy of a negative rate, despite the fact that Japan is a 100% importer of energy, oil. They've had very mild inflation because the Bank of Japan is the only central bank that hasn't fallen into this trap of this false belief, this mythology that rate hikes squash inflation. So kudos to the Bank of Japan. The Fed is not the Bank of Japan. It's not run by the same kind of people, and they are going to continue, at the very least, with this hawkish tone. And I said, beware of the Powell press conference that follows always a half an hour after the rate decision, because he's going to shit all over the market. He's going to have this hawkish tone, and he basically has a green light to do this from the White House, because the White House wants the Fed to take care of the inflation problem. But all the Fed is doing is making the inflation problem worse by keeping interest rates high or raising interest rates. So the monetarist zombies, they saw that, and of course, they sold the market down. And if it were not for the Fed, let me just say this, when you strip away all this monetarism bullshit, because I don't follow this at all, and if I do follow it to any degree, it's as a contrarian indicator, because the monetarists don't even understand monetary policy and the effects of monetary policy. So when I see them react, I generally go opposite. And if it were not for the fact that we are feeling the impact of that tax drain that I've been telling you guys about, I would say that this is a great buying opportunity, that you got to go against the zombies. They sold today, and this would be a great buying opportunity. But I'm not saying that, because we're still in the negative effect of the tax drain. And by my calculations, the tax drain, if you adjust for that 50 billion intra-governmental transfer that popped up on the daily Treasury statement on Friday, remember, I've been talking about that. It made Friday's drain basically go away. But that was just an intra-governmental transfer. In other words, I explained it yesterday. It's like the government taking money from one pocket and putting it into another pocket. It was not a transfer into the non-government, like a transfer into the economy. No, it just went from one government agency to the other. or it went from the Treasury to a government agency. So it didn't get into the economy. So if you adjust for that, which I did in my calculations, we're still about a 78, 79 billion drain. We got to recover that. Once I start seeing that come back, and it came back a little bit yesterday, we were about an 85 billion. Now we're down to about a 78 billion. Once I start seeing that come back or get very close to recovering or recouping that drain, then that's your buy signal, okay? So it's not hard. I mean, somebody asked me the other day, what price level in the S&P do you think is a good buy level? And I tend to shy away from, I mean, I can look at, for example, a chart with the commitments of traders, where positions were taken, where positions were lifted, by which participant, which market participant, whether it's a producer or a commercial or a large speculative fund or a small speculator. I can look at a chart with the commitments of traders, and I can give you price levels where I think there's going to be support or resistance. But what I'd rather do is wait for conditions, because conditions determine the price, not the other way around. Price does not determine conditions. Conditions determine the price. So by conditions, I mean, when are these flows, when are we going to recover these drained flows, okay? When that happens, then you start buying the dips. That's the best way to go about it. Because just looking at a price level right now, if I threw something out there, for example, 43.50 on the S&P, and I don't know if it gets down there that we are necessarily in the clear based on having recovered that tax drain. You see what I'm saying? So what I'd rather do is wait until the tax drain is recovered and then say, buy every dip, every day. Just buy the dips. You see? That's the preferred way to go about it. Not guessing some arbitrary price, because you don't know what the conditions are going to be. All right? Conditions might still be, we're in a drain scenario. So the price there is not going to do much for you. Okay? You want to have conditions on your side. All right, so that pretty much sums up today. We got the EIA weekly petroleum status report. There was another draw, 2.1 million draw in crude. There was a rebound in exports. I mean, the data looked pretty good in the EIA report, but like I've been saying, crude was down today. Like I've been telling you guys, producers and banks have been selling into this rally. And that is not a picture that makes me all that bullish. There's strong hands. They're selling into this rally. So I expect to see a pullback. The rally went a little bit farther than I thought. I mean, they've been selling into this rally for the last 2-3 weeks, but they're generally right. I don't like to go against these strong hands. I mean, on the opposite side of these guys, you got the leveraged funds, these commodity funds, and you got small speculators. I mean, they don't have the insight and the savvy that the other two cohorts that I mentioned have. But by the same token, if crude pulls back, you will see these guys on the buy side. In other words, you will see producers, you will see the banks come back in on the buy side. But right now, when I look at what they've been doing, it makes me a little bit cautious on the oil price rally. So that's the update for today. Kind of brief, but not a whole lot to say. We're still in that. We got to recover that 78 billion of drain, and then everything is going to be fine. So I'm watching that every day. And by the way, I update my subscribers daily on those numbers. So if you want to have that information, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial for MMT Trader. Bye.